Okay, let's dive right into this. Whether you're running a hyperscaler, managing enterprise infrastructure, or directing some major tech investments, this explainer is designed specifically as your strategic briefing. We are looking closely at the shifting tectonic plates of the 2026 AI infrastructure market. This landscape has completely transformed over the last couple of years, and the decisions being made right now, they are absolutely going to dictate who controls the compute ecosystems for the next decade.
So, here's our roadmap for today. We're going to quickly map out the new financial hierarchy, analyze Broadcom's software-led pivot, and then explore the really vital shift toward balanced AI systems. After that, we'll get into Intel's deepening collaboration with Google and their Jaguar Shores pivot before wrapping up with the systemic risks of infrastructure concentration. Today is all about stripping away the hype and focusing purely on margins and the bottom line. Let's get to it.
Section 1, the new AI market hierarchy, and specifically, the financial concentration we're seeing in semiconductor infrastructure. When we aggregate the latest 2026 annual reports from the top 5 semiconductor companies, we are looking at a market generating an absolutely astounding $489.7 billion in revenue. But listen, this isn't just a rising tide lifting all boats. No, it's about a massive, really aggressive reordering of the competitive hierarchy, where financial returns have become highly concentrated. Let this number sink in for a second. $215.9 billion. That is Nvidia's fiscal 2026 revenue alone. To put that into perspective, that's a 65% year-over-year growth, and that's sitting right on top of a 114% increase from the year before. They are now, without a doubt, the undisputed largest semiconductor company in the world by annual sales, pulling in more than 4 times the revenue of Intel. It's just a stunning reflection of how capital expenditure from the cloud giants has fundamentally reshaped this entire industry.
Now, this breakdown brilliantly illustrates the stark financial disparities across the sector today, because scale alone, that doesn't dictate competitive power anymore. It is all about profitability and market position. Just look at Nvidia. They're commanding these monopoly-like net margins of 55.6%, pulling in over $120 billion in net income. Then you've got TSMC sitting in this highly defensible, pretty much unassailable position as the world's leading pure-play foundry. They're capturing a 45.1% net margin just by supplying everyone, completely avoiding the chip design risks. And then we'll look at Intel's negative 0.5% net margin. They are clearly navigating a very complex, very costly restructuring phase. The whole tech landscape has basically split in two, those supplying the AI boom and those racing to catch up.
Moving on to Section 2. Let's talk about Broadcom's software-led strategy, alternative revenue models, and resiliency.
Because hey, not everyone is playing the exact same hardware game. Take Broadcom. They've quietly overtaken Intel in total revenue by pulling off this fascinating strategic pivot. It's a really stark contrast to the pure-play hardware reliance we see with their peers. Just notice the composition of Broadcom's $63.9 billion revenue here. Sure, they have a massive and growing AI semiconductor business that's $20 billion driven by custom XPUs and networking silicon for hyperscalers like Google and Meta. But you know what's really interesting? Look at that huge $27 billion chunk. That comes entirely from infrastructure software, largely driven by their integration of VMware.
So what's the real strategic takeaway for us as executives? Well, it's simple. Hardware is cyclical, but software is durable. By marrying their custom silicon business with massive recurring enterprise software subscriptions, Broadcom has successfully insulated themselves from the wild, unpredictable swings of the hardware market. They've created a highly resilient, low-volatility financial profile. They are proving, right here, that dominating the AI infrastructure space isn't only about building the fastest merchant GPUs, it's about owning durable, subscription-based layers of the entire tech stack.
All right, Section 3, the need for balanced systems. We are moving way beyond raw GPU power here. And this brings us to a really critical realization shaping 2026. The industry is rapidly moving away from just frantically hoarding specialized chips, and we're finally waking up to the systemic realities of the modern data center. We really have to contrast these two different architectures. On one hand, you've got specialized AI accelerators, your standard GPUs and custom XPUs. They provide that incredible brute force raw compute necessary for training massive models. But here's the catch. AI simply cannot run on accelerators alone. On the other hand, you have general-purpose infrastructure. As AI workloads shift from that basic foundational training over to complex agentic inference, you suddenly need system orchestration, You need networking, security, tool calling. And all of that requires a totally balanced ecosystem powered by CPUs and custom infrastructure processing units, or IPUs. You literally cannot scale one without scaling the other.
Let's look at Section 4, the Intel and Google collaboration, which is a perfect example of deepening ecosystem diversification. This multi-year collaboration between Intel and Google Cloud is basically the blueprint for this industry-wide shift toward balanced architecture. It represents a very deliberate move away from single-vendor accelerator dominance. I love this quote from their announcement. It perfectly captures the strategic zeitgeist right now. AI doesn't run on accelerators alone. It runs on systems, and CPUs are at the core of those systems. It just perfectly underscores the vital, ongoing need for general-purpose compute in hyperscale environments. As AI gets more complex, the CPU is aggressively reasserting its importance as the core orchestrator of the entire workload. Let's break down what this alliance actually looks like in practice. Google is deploying Intel's Xeon 6 processors across its workload-optimized instances. But honestly, the more important piece here is that they are co-developing custom ASIC infrastructure processing units together. These IPUs step in to handle the heavy lifting of networking, storage, and security. By freeing up the host CPU from those annoying overhead taxes, hyperscalers end up saving highly expensive compute cycles, and they get far more predictable performance out of their hardware at massive scales. It prevents hardware lock-in, it drastically reduces system complexity, and, like I said, it serves as the ultimate blueprint for the multi-vendor heterogeneous data centers we are moving toward.
On to Section 5, Next-Gen Hardware. Let's talk about Jaguar Shores and Intel's long-term commitment. So Intel isn't just resting on its traditional CPU laurels here. They are aggressively adapting their internal hardware roadmap to meet these new systems-level demands in the AI accelerator space. If we map out their product timeline, you can see that early in 2026, Intel had to make the really tough call to cancel the long-anticipated Falcon Shores platform. But they didn't retreat. Actually, scratch that. They immediately shifted their entire focus to Jaguar Shores. By July, it was fully confirmed that this massive new AI processor is going to utilize next-generation HBM4 memory from SK Hynix. Jaguar Shores is actually designed to be deployed right alongside future Diamond Rapids Xeon processors, creating this highly integrated high-performance system. This pivot is a huge signal of Intel's aggressive commitment to staying competitive at the very top tier of the AI hardware market.
Finally, Section 6, Infrastructure, Concentration, and Risk. It's time to navigate these multi-vendor realities.
We've talked a lot about hardware, we've talked about revenues, but we really have to step back and analyze the systemic risks of market concentration for tech stakeholders. So I want to pose this question directly to you. How does infrastructure concentration impact your long-term profitability and risk? Because think about it, if your entire data center strategy, your whole AI capability is bottlenecked by just a single supplier, you are exposing your business to massive supply chain constraints and incredible pricing leverage.
Just consider the financial exposure we are seeing right now. Nvidia is incredibly dominant for sure, but they derive a staggering 90% of their revenue directly from the AI and data center segment. That is extreme reliance on the sustainability of hyperscaler CapEx. For buyers, that kind of single-vendor reliance creates entirely unacceptable long-term pricing exposure, and that is exactly why we are seeing the industry aggressively shift toward multi-vendor ecosystems. Just look at Meta. They've committed massively to AMD's MI-series accelerators right alongside their own custom silicon, just to ensure they aren't entirely dependent on one ecosystem. The crucial point here is that vendor diversification is no longer optional. It is the ultimate survival strategy for maintaining your margins and mitigating risk over the coming decade.
I want to conclude this explainer by leaving you with one final, pretty provocative thought. In a market that is rapidly transitioning from single-vendor hardware dominance to balanced, multi-vendor ecosystems fueled by custom silicon and integrated software, who ultimately captures the most durable value in the AI stack? Is it the pure-play foundry, the software orchestrator, or maybe the custom system designer? As you go back and plan your infrastructure investments for 2027 and beyond, that is the question that absolutely needs to drive your strategy. Thank you so much for joining me for this explainer, and I'll see you next time.